None of the nation's biggest banks will need to immediately raise capital, which of course was the first part of the stress test, though one, as you said, Wells Fargo will be reducing its dividend. On the capital levels first, as expected, Goldman Sachs is currently sitting below their required Common Equity Tier 1 or CET1 ratio. Their required level, 13.7%. They were at 12.5% at the end of Q1, but said in a release that they were already up to 13%. All analysts expect them to reach the desired level organically by the 1st of October deadline. All of the other banks tested are above their required capital levels. Of the other big six banks, JP Morgan, in fact, cut it closest, required CET1 11.3%. The actual level at the end of Q1 was 11.5%. Of those big six, Goldman Sachs, JP Morgan, Citi, Bank of America, and Morgan Stanley were able to recommit to their dividends for now. The banks are limited to paying, as you said, Joe, no more than 100% of trailing 12 months earnings, so multiple quarters of low or no earnings would change the bargain. JP Morgan CEO Jamie Dimon said, quote, "If there's significant deterioration in the future outlook, the firm will, of course, consider reducing dividends," end quote. Wells Fargo indicated that they would be reducing their dividend. As you said, they will clarify the scale of that reduction when they report Q2 earnings on the 14th of July, tantalizingly close to earnings, Joe, when they also said they expect to increase allowance for credit reserves substantially more than they did in Q1. That, of course, will be a theme to watch for earnings across all of the banks. Wells Fargo shares down by about 1% pre-market. All of the banks face a second stress test this year in the fall. That fact alone is what led to the large share price declines late last week. And despite gains yesterday and a bit overnight, we're still not recouping those losses from last week, guys.